Good morning, good afternoon, good evening, and welcome to today's webinar on governing voluntary carbon markets. My name is Ann Florini. I am clinical professor at the Thunderbird School of Global Management at Arizona State University. This webinar is part of our series on finance and sustainability. And it is also part of another webinar series at George Washington University. And I want to start by thanking today's co-sponsor, the Institute for International Economic Policy at the George Washington University Elliott School of International Relations. In just a moment, I will introduce its director, Jay Shambaugh, and the Institute's distinguished visiting scholar, Sunil Sharma, to add to some welcoming remarks. In previous webinars in the Finance and Sustainability series, we've explored key issues of how the global financial system and the global sustainability agenda are increasingly intertwined. We had Simon Zadek about a year ago from the Finance for Biodiversity Initiative, showing us the ways in which the numbers of initiatives that are underway in which global finance is being greened with a host of regulatory changes and practices on the ground, although there's still a long way to go. We heard from Ralph Chamey of the IMF and Connell Follenkamp of Duke University about new methods for valuing the contributions made by keystone species and ecosystems to the global economy, with big implications for how we can measure going forward the value of those services. Early this year, we heard from Sir David Hendry and Dr. Jennifer Castle of Oxford University about how to take stock of climate change, what's happened, what's happening now, and what we can expect in the future. All of that provides a great background for understanding today's topic. We're zeroing in on a particularly challenging approach to managing the climate emergency that now faces us. Whether it is possible to create new markets that could channel tens or hundreds of billions of dollars effectively into projects that draw greenhouse gases out of the atmosphere or prevent emissions from happening in the first place, and help move the global economy towards what's being called net zero greenhouse gas emissions by the year 2050. Today, we have the privilege of hearing from two people who have been deeply involved in these matters and most recently have been named to the board of a new multi-stakeholder initiative that has been driven by some weighty names in global finance. They are aiming to rapidly scale up these so-called voluntary carbon markets. But before I introduce them, let me turn it over to Jay Shambaugh for his welcoming remarks.
Thanks very much, Ann. Good morning, good afternoon, or good evening, depending on where you are or when you're watching this. My name is Jay Shambaugh. I'm the director of the Institute for International Economic Policy at George Washington University. We at IIEP are very pleased to be co-hosting this event on voluntary carbon markets as part of our series on rethinking capitalism and democracy, and to, of course, once again be partnering with the great team at Thunderbird ASU. For those of you who don't know us, IIEP is located at the Elliott School at GW and is a cross-school interdisciplinary research center. IIEP aims to serve as a catalyst for high-quality, multidisciplinary, and nonpartisan research on policy issues that surround issues of economic globalization. And we interpret that mandate quite broadly, so it includes areas of trade or international finance, international development, poverty, climate change, and really economic policy more broadly. We've been very busy at IIEP. We have a number of series on poverty, on inequality, on rethinking capitalism and democracy, as well as on China's economy and India's economy and other events as well. I encourage you to take a look at our website for further events. We have an event tomorrow on India's economy in a post-COVID world, and we have a YouTube channel where you could see the entire history of events over the last year or year and a half. I'd like to acknowledge the IIEP Executive Circle for their support and welcome any members in attendance. And now I'd like to turn it over to IIEP Distinguished Visiting Scholar Sunil Sharma, who's been organizing this year-long virtual series. Sunil.
Thanks, Ann. Thanks, Jay. And let me add my welcome to everybody. So today we have the 10th seminar in our monthly series on rethinking capitalism and democracy, and we are glad to have it co-sponsored by ASU-Thunderbird. Let me say a few words on the series. Last month's seminar by Professor Peter Deitch of University of Victoria looked at one of the major systemic issues we are currently grappling with, the rise in income inequality. Several of the seminars that Ann mentioned have been jointly sponsored by our series, as both institutions are interested in these big systemic questions. Earlier seminars in our series address taking stock of climate change, valuing nature and biodiversity, governance and the architecture of global finance, financial regulation for the 21st century, food systems, and peace and sustainable development. Today's seminar on governing the new voluntary carbon markets examines how markets can be harnessed for public purposes. In this case, whether and how markets can be used to offset carbon. Traditional markets generally involve private players in the production and sale of goods and services. In the carbon offset market, the motivation is to achieve a public purpose, and we face fundamental questions of how such a market can be structured and governed to ensure that it achieves its objective, rather than serving as a vehicle for greenwashing and the generation of fees for intermediaries. The employment of markets in the pursuit of public purpose can be seen as complementing the rise in purpose-driven businesses and the move away from seeing shareholder value maximization as the sole purpose of corporate entities. We need to be experimenting to see what works and how it can be scaled to achieve our climate objectives. If you agree with the science, it is hard to disagree with the conclusion that Matt Bai's article comes to in the Washington Post today. Acting locally was a fine idea in its time. Acting globally and at scale is the only option left. So with those remarks, let me turn it back to Ann to start the seminar.
Thank you so much, Sunil. So the way that we are going to run the webinar today is I'm going to provide some context in the way of some opening remarks and a few slides, and then turn it over to Mark Kenber, the first of our speakers, and then to Kavita Prakash-Mani, who I will introduce after I've run through these opening slides. And the reason that I am providing this context is because we have quite a mixed audience with a number of people who have real background in this area and some people who are fairly new to the whole climate change debate. So just to make sure that we're all starting from the same starting point, I'm going to share my screen. So as I said, we're going to start with a bit of context so that the issue of governing voluntary carbon markets is in its proper place in the whole climate debate. Quick refresher on what do we mean by climate change? This, I think, is increasingly familiar to everybody. We are essentially thickening the blanket that our atmosphere wraps around the planet so that less of the heat that normally escapes through the atmosphere from the sun's rays can get out. So it's a very simple, basic physics equation, understanding how this happens. The problem is that there are natural fluctuations in the thickness of that blanket, but we have taken those natural fluctuations and put them on steroids. We have had skyrocketing carbon dioxide emissions over the last fairly short period, mostly the last 50 to 70 years, and the pace has been increasing. This is a slide borrowed from our good friends at Climate Central, which is a wonderful NGO that does translation of climate science. As it shows, even though we're talking about what seem to be relatively small numbers in global average temperatures, they have very, very big effects. One of the big effects they have is that a small shift in the average means a big increase in days of heat and extreme heat. And this is just one of the many, many kinds of problems that climate change causes. There's already been a great deal of global discussion about that. What we're really talking about today is focused on some of the solutions. In less than 2 weeks, the world convenes in Glasgow for the 26th meeting of the Conference of the Parties to the United Nations Framework Convention on Climate Change. This is the most significant meeting since their meeting in Paris in 2015. You've all heard of the Paris Agreement. What the Paris Agreement established, among many other things, was a process for the world's governments and many other actors to come together every 5 years, figure out what have we been doing so far, what can we commit to do now, and what does the science and the experience of living with climate change tell us about how we have to ratchet up. And as I said, this happens every 5 years normally. COVID obviously got in the way for 2020, so they're now meeting in 2021 in Glasgow. Among the convened are not just governments, but business and finance leaders, civil society organizations, representatives of the world's youth who will spend their lives in a climate-altered world, and a plethora of people who have ideas about how we get ourselves out of this mess. Today, we focus on one of those ideas, carbon offset markets. Although we have some good news on the technology side, particularly the plummeting costs and growing use of renewable energy sources that don't emit greenhouse gases, I'm afraid we've left this problem far too late to rely on a gradual, technologically driven and purely market-driven transition. The Intergovernmental Panel on Climate Change just recently came out with its latest study of what is actually happening in the world with climate change. And every time they do this, they have a set of scenarios for, depending on what humanity does about greenhouse gas emissions, what does the future hold for us? What this chart shows you is if we release various levels of carbon dioxide over the coming years, where is that going to take us in terms of overall temperature increases? That gray box at the bottom is where we really want to be, because that has some hope of holding temperature increases to levels that we can manage. The bottom light blue line represents a scenario that gives us a 50% chance of staying below the threshold of a 1.5 degrees Celsius planetary fever. Getting above 1.5 degrees, we now know, starts leading to some very serious problems. The dark blue line, which gives us a 50% chance of staying below 2 degrees Celsius, on that line, we basically lose all carbon reefs. We condemn millions upon millions of people to poverty. The kinds of disruptions that we have seen with wildfires, heat waves, floods, all the rest of it in recent years are just a foretaste of what we can see even under or what we're going to get even under these scenarios. These are already catastrophic fevers. To be on either of those lines, particularly the 1.5 degree scenario, there's pretty much no way that we can get there unless we start taking some carbon dioxide out of the atmosphere. We not only have to stop the emissions we're currently doing over the next 30 years, but we have to be able to draw down as well. So those two scenarios depend on us doing something that we're just starting to figure out how to do. We've wasted so many decades arguing over whether climate change was real and an imminent threat. So now we need to find ways to both turn off the tap of emissions and increase the size of the drain of net removals. The planet is actually normally pretty good at keeping those things in balance. Forests absorb carbon dioxide, soils absorb carbon dioxide, oceans do. These are things that already happen naturally, but they aren't happening at a pace that can keep up with the emissions that we are putting into the atmosphere. So we have to find some way of removing or sequestering some of the pollution that's accrued since the start of the Industrial Revolution. And that brings us to my final slide on how today's topic of voluntary carbon markets fit in. You can think of it as two inverse pyramids. Within the big frame of climate, nature, and society, and all the kinds of actions that we know we need to take, is a set of decarbonization methods, mitigation methods. It is often talked about as though this is opposed to offsets, but in fact, we need both decarbonization and some degree of offsets on very large scales, as much as we can do, as fast as we can do. Voluntary carbon markets are one of the ways that we try to do both decarbonization and drawdown. Now, within the voluntary carbon markets, there are all sorts of very tricky issues about what's on the supply side, what projects are out there that can actually do this, what's on the demand side, who wants to be investing in these carbon markets, who wants to be investing in these efforts. You're going to hear a lot about that from today's speaker. And in between, how do you get a market operating at the proper scale, large enough, quickly enough to make the difference that we needed to make? In addition, the kinds of issues that we're going to be talking about for voluntary carbon markets, these are where companies just decide or others just decide they're going to invest in these kinds of projects. We're also seeing the rise of what's called compliance markets, where governments say you must offset whatever emissions you don't reduce. One of the things that is going to be negotiated in Glasgow is what's called Article 6 of the Paris Agreement, which is all about those kinds of compliance markets. So the issues that we're talking about today go beyond the discussions about the voluntary carbon markets and apply to a much wider range of issues and potentially to other market issues, other nature markets as well. So with that, let me stop sharing and let me now turn to our first speaker, Mark Kenber. Mark has worked on environment, climate, and energy issues for over 2 decades in government, NGOs, and the private sector. He's currently the managing director of Orbitus, which is a climate advisors initiative that aims to make capital providers aware of climate transition risks to investments in things like tropical soft commodity production and shift their lending and investment decisions accordingly. He has worked across a wide variety of actors, all of which are detailed in the flyer that advertise this event. Most notably for our purposes, Mark has recently been elected to the board of directors of the new multi-stakeholder initiative that grew out of the high-level task force on scaling voluntary carbon markets. Mark, let me turn it over to you.
Thank you very much indeed, Anne. And I am just going to share my screen as well. So I think it was very useful to start with Anne's pyramids, because often if you're in the voluntary carbon market bubble that I live in, it can appear that the whole world is only thinking about voluntary carbon markets and nothing else. And it's really important to remember, and I'm going to give you some figures in a moment, to show that this, to remember that this is a very small part of what needs to be a very large toolkit if we're going to get on that 1.5 degree pathway, or at best 50-50 chance of hitting 1.5 degree pathway that Anne presented a few moments ago. The voluntary carbon market, as I say, is one part of that toolkit. And to a certain extent, and I hope this will become clear over the next few minutes, the very existence of a voluntary carbon market 33 years after the beginning of the intergovernmental negotiating process that led to the UNFCCC and subsequently to the Kyoto Protocol and where we are now, the fact that we still have a voluntary carbon market is testament to the fact that we have collectively failed to put in place the policies and regulations that we need to drive down carbon. We've known about climate change for a very long time, and we've done nothing very much about it for a just slightly less longer time. And voluntary carbon markets exist because to fill a gap in policy and regulation. So I'm going to start by just talking what are voluntary carbon markets, and apologies to those who are already well versed in this subject. Roughly, most voluntary carbon markets are based on projects, and effectively a company or an individual, whether they want to use the project themselves or to generate income from it, invest in a project that reduce, avoid, or remove emissions. And just to give some examples of what that means, reducing emissions could be, for example, investing in a brick factory and making it more efficient so it uses less diesel and its generators and other fuels in the system, and therefore, after the project intervention, has lower emissions than it did beforehand. And as I'm going to come back to shortly, has lower emissions than it would have otherwise had without the project intervention. So if you imagine, for example, that the production of a brick produces a kilo of carbon dioxide, after the project intervention, each brick requires 0.8 kilograms of carbon dioxide emissions in its production, then there's been a 20% saving, and multiply that by the number of bricks compared to what would have happened otherwise, and you've generated an emissions reduction. Emissions avoidance is also another form of reduction, but tends to be an investment in something that stops emissions from happening in the first place. And the obvious and most widespread example of this is avoiding deforestation. As we know, tropical forests are disappearing at an alarming rate. They are important not only for biodiversity and the livelihoods of the people who live there, but they are big stores of carbon. They have stored carbon we have emitted over the previous decades and centuries. As they get chopped down and they burn or decompose, so either in the form of carbon dioxide or methane, those emissions go to the atmosphere and continue to exacerbate the problem we have. So another kind of voluntary carbon market intervention would be to protect that forest. You could do it in a very crude way by putting a fence around it, and we'll hear lots of reasons why that's not a good idea. Other ways would be to create projects that incentivize the people who live in or own those forests to conserve them rather than chopping them down. And carbon market investments can provide that incentive. And then finally, removing emissions. And Anne has already touched on this, but there are many ways in which emissions can be taken out of the atmosphere, whether that be the oceans, or by planting trees, or trapping more carbon in the soil, or mechanical methods such as direct air capture, which are techniques to suck carbon dioxide out of the atmosphere. So the voluntary carbon market covers all those project types, and the projects, as well as generating potentially an economic or financial return. For example, if you were replacing a coal-fired power station with a wind farm, you would generate a return from the sale of the electricity. There's an additional return which comes from the sale of the carbon credits, remembering that the carbon credits are the difference between what the emissions would have been without the project and what happens after the project is implemented. And those voluntary carbon markets, why do they exist at all? Well, the main reason is because companies, and this has happened for a fair amount of time, but increasingly, as we'll see in the last few years, want to be able to make claims, whether it be to the public as part of their advertising, to their shareholders and investors in response to their concerns, or more generally to demonstrate to their regulators that they are taking action. They can use credits to underpin their corporate claims. So for example, if I'm a company and I want to claim to be carbon neutral and I have 100 tons of emissions, I might find easy ways to reduce my emissions at source by changing my fuel source or being more efficient by 50 to 50 tons, but the remaining 50 are very difficult. So I buy credits to cover those 50 tons. And then I can say my net impact on the environment is 0 emissions, and I can therefore call myself carbon neutral. And that depends very explicitly on the fact that for the atmosphere, it doesn't matter where carbon dioxide or other greenhouse gas emissions come from. If some of them come from my plant, but I reduce them in a third country, as long as all things being equal, the reductions are the same as my emissions, then I can claim carbon neutrality. However, it's important to note that in almost all cases, these credits cannot be used to meet compliance obligations. So if you have a target set by your government, in few, if any cases, is the voluntary use of carbon credits allowed to meet those targets. It's worth noting that many projects, most of, if not always, have been in developing countries. And this has been existed for a long time, in part because it's recognized that there are many low-cost emissions cutting, removal, or avoiding opportunities, particularly in the forest and land use sector, but not exclusively in developing countries, but also because until the adoption of the Paris Agreement, most developing countries didn't have compliance obligations under an international agreement or framework. And therefore, companies recognized, and we'll talk a bit later, that at the low prices in the voluntary carbon market, this was an easy and attractive way to reduce emissions, but also from a global perspective, a way of cutting emissions in developing countries where those opportunities were manifold and cheap. And as I mentioned, because it doesn't matter where greenhouse gas emissions reductions take place, the more the merrier. It's also worth noting that the voluntary side of this is not only in the context of companies voluntarily using or investing in these markets, but they're voluntary because they're almost always, and there are some emerging exceptions, for example, in the case of Colombia, where the voluntary carbon market is part of a national policy package, but in most cases, they're outside government control, policy and regulation. And so it's a almost self-regulating market. There are a number of standards that exist which you can have projects certified against and which then therefore allow the issuance of credits, and a number of rules about independent third-party validation and verification. So it looks like a compliance market, but it is very much a voluntary market. And I emphasize that fact in the context of what Anne was saying about the Glasgow climate negotiations, where rules about government regulated markets will emerge. And one of the big questions after the climate negotiations will be how, if and how do these voluntary carbon markets intersect with compliance markets. So next slide is there. So are these things important and significant? Well, over 20, voluntary carbon markets have existed for getting on for 25 years in different guises. But over the last 20 years, well, until 2019, in total, carbon markets issued about 1 billion tons of CO2 equivalent of credits. So if we think that global emissions at the moment are around 50 or 55 gigatons per year, that is the total over 20 years is only equivalent to about 4%, 2% of 1 year's emissions. So they have been very small. And if you think that the average price for a ton of carbon in the voluntary carbon market is about $3 or so, they go a bit higher depending if they have other attributes such as sustainable development or whatever it may be. But it's a market that is, on the whole, pretty small. $3–5 billion over 20 years is not much. However, in the first 9 months of 2021, so up to the end of September, we'd already seen issuances of a quarter of, an equivalent to a quarter of all the credits that have been generated over the previous 20 years. So $250 million credits by the end of September, and it's set to accelerate. It looks like that by the end of this year, we could have over 350 million tons of CO2 equivalent, CO2 equivalent, and that would be roughly a third in just 1 year of everything that's happened in the last 20 years. And this is only likely to accelerate. All the projections suggest markets that could be up to 1 billion tons or more of emission reduction a year. And so where's this coming from? Well, it's partly the increased pressure on companies to take action on climate change, but equally important, to be seen to be taking action on climate change. And that's becoming increasingly a differentiator for companies in the market, both because dealing with climate change in a preemptive fashion means that you are reducing your risks, both climate change itself and of policy action, but also because consumers are increasingly demanding products that are seen to be climate friendly. And so we are beginning to see products that are branded as a carbon neutral soap or a climate friendly detergent or whatever it may be. So lots of pressure on companies from their investors, from their shareholders, and from their public to be seen to be taking action. And as I said before, often using carbon credits is a cheaper way of taking action than making reductions at source. But even if you are making deep decarbonization at source, there will be still always some residual that you are unable to reduce, and therefore corporates can buy credits. And we're seeing since Paris Agreement, under the Race to Zero, which is one of the campaigns led by the high-level champions of COP26 in Glasgow, over 3,500 companies have made commitments about being on a net zero aligned pathway. And many of those companies are also looking to voluntary carbon markets to meet carbon neutral claims in the short term. The market has also changed quite a lot over the years. In the first 15 or 20 years, the vast majority of projects were renewable energy projects. As renewable energy technologies have got cheaper, significantly cheaper over the last 20 years, the small difference that carbon crediting can make, both in terms of an income stream, but also because they're often denominated in hard currencies, have enabled renewable energy projects to take place in a lot of developing countries. However, we've just seen a shift over the last 2 years that while renewables continue to be important, many of the standards now believe that renewable energy projects don't need carbon finance to succeed. And at the same time, we've been told by the IPCC and many other reports that if we want to hit our climate change targets, keep on that 1.5 degree pathway, but also recognize the alarming rate of loss of biodiversity and natural habitats, that there is a big opportunity to invest in what are called nature-based solutions. So reforestation, protecting existing forests, sustainable agriculture, and a whole range of land-related emission reduction projects. And so for the first time in 2021, land use-based projects are top in terms of the portion of number of credits that have been issued, and also of those that have been retired, i.e. used by corporates to meet their claims. And we've also seen two initiatives, one of which Anne mentioned, to the Voluntary Carbon Market Council, which emerged out of the Task Force for Scaling the Voluntary Carbon Market, and the Voluntary Carbon Market Integrity Initiative, which are looking to create frameworks to manage that growth and ensure that these markets have a high integrity, however you want to define high integrity. So there's a lot of debate, and many of you will have seen in the press and on the news lots of arguments about voluntary carbon markets and the use of offsets in general. And just recently, a large group of NGOs wrote to the UN Secretary General suggesting that there was no role for offsets in any credible climate policy. But there are plenty of others who say, while we would, and I would count myself amongst these, while we accept that the primary focus has to be decarbonisation in every company, in every household, and every country at source, if we want to protect the world's remaining forests, if we want to go above and beyond and accelerate and deepen climate action, then voluntary carbon markets and carbon markets in general have an important role to play. So they can drive finance to activities, whether those are projects or programs or sectors that would not otherwise get that investment. And that is often the case in developing countries, and particularly, as I mentioned before, where carbon credits can provide a hard currency revenue stream, which gives confidence, and you can sign an emission reduction purchase agreement for 10, 15, or 20 years, which gives, again, a predictable revenue stream for a project. So additional finance, again, filling gaps in what one might argue that governments and companies should already be doing, but we are where we are. So this is one way of channeling finance to important projects. It can make, as I say, it makes the difference between projects that are unviable or be unattractive and those that are viable. Many projects, and I think Kavita will talk more to this in a moment, produce additional benefits. They can provide, often, if we think about projects that implement clean cook stoves to replace traditional wood burning stoves, they can stop deforestation, they can reduce emissions, but they can also really make lives a lot easier for people who spend hours and hours, mainly women, each day searching for firewood. They can also reduce local air pollution. They can provide more sustainable food sources. So they can generate additional benefits, including to the local communities where the projects take place. They've also can generate innovations. And we've seen across a whole range of emission reduction projects over the last 20 years that they have the ability to use carbon finance to start a project. And we can look at micro scale solar being a very good example of this. In early projects existed because of carbon finance, because there was no way to fund them otherwise. But as they were proved popular and showed that they could work, those microgrids or community level solar systems have spread all around the world with and without carbon finance. So they can spill over in technology and also have spillover into policy as governments recognize that these projects represent scalable solutions. They can then be driven by policy rather than just voluntary action. And they can also, as it should say, help, not HEP, build capacity for greenhouse gas mitigation. The Clean Development Mechanism, which was a carbon market mechanism under the Kyoto Protocol, drove the creation of a large number of small and medium-sized companies that looked at project development, project assessment, project validation and verification, all skills that are needed and will continue to be needed as climate policy increases and becomes more ambitious. So lots of positive, potentially positive impacts of voluntary carbon markets. But of course, they are viewed with skepticism by many in the NGO community and beyond. And one of the main reasons for this, and the subject of the criticisms that we've heard in recent days and weeks, is that particularly for those sectors that are high emitters, that are responsible for example, production and use of fossil fuels, they are seen as a way of greenwashing, a way of avoiding taking that difficult action. So, for example, the IEA recently said that if we want to keep on a 1.5 degree pathway, then oil and gas exploration needs to stop. Stop, full stop. Obviously, there are many companies that don't like that. It's damaging perhaps to their business models, and therefore think, well, if we can buy a lot of offsets, we can have carbon neutral growth, and that means everything's okay. So there are many who would argue, and I have some sympathy with this view, that just unbridled use of offsets and use of offsets to avoid taking action at source, say, or not on a science-based pathway, delays emissions reductions, but it also delays the more systemic transformation, the adoption of radical new technologies that are too expensive to be funded through the carbon market, but need to come into play. And in the same way as the use of offset credits could take pressure off companies to act at source, it can also take pressure off governments to implement ambitious policies. If they can say, look, all our companies are using carbon credits, they're all claiming carbon neutrality, we don't need more policy, then that's because we know that governments don't like putting in place policies or making decisions that are perceived to be unpopular, this can be an escape clause for them. And then there are sort of more technical problems with carbon markets that, for example, if I'm a company investing in a project in your jurisdiction, what happens if you say, well, my emissions reductions have gone down in my region, and I can also say I'm carbon neutral, then we're both taking credit for the same emissions reduction, while the atmosphere continues to see emissions and we see more of the fever that Anne referred to. Then, of course, there is how do you judge whether a project would or wouldn't have happened? I mentioned at the very beginning, the underlying principle of voluntary carbon projects is that you are comparing the after project scenario, or what's happened after the project, with what would have happened otherwise. So you had a coal-fired power station, you replace it with a wind turbine, you're comparing what the wind turbine's emissions are with what the coal-fired power station's emissions would have been. And when we're talking about counterfactuals, we can never say that with any certainty. We can also not know whether that wind farm would have been implemented anyway. Maybe the owners of the coal-fired power station had had enough, or it wasn't making any money. If you're getting credits for doing something that would have happened anyway, then you're not reducing emissions. And finally, there is the risk, and I think we'll come back to this, that in the zeal to reduce emissions, or the zeal to generate projects that produce carbon credits, while lip service is paid to the engagement with local communities, often that lip service is what I say is just lip service, and local communities may not find that they share in the benefits of projects. They may even be worse off in the case where forests exist and they have fences put around them, that where people used to access for food or fuel no longer have access to that. And so while they may reduce emissions, they may not do anything for making livelihoods better, and therefore may generate opposition to climate change action. So just finally, and I think this was where we're going to go in the conversation, what do we need to make voluntary carbons markets meet their public purpose? And the public purpose must and can only be accelerating and deepening action to reduce greenhouse gas emissions and channel finance where it's needed. So we need to have end-to-end transparency. We need to know what the projects are doing. We need to be able to judge how their additionality has been tested. We need to know that the claims aren't being double made or double counted. And we need to know that the local communities and anybody affected are sharing in the benefits and at a minimum are not being harmed. We need to have clear rules on what constitutes a real emission reduction project. You will have all heard and will increasingly hear people banding around the phrase high integrity carbon markets. But when you ask people to define that, rarely do you get a concrete definition. And if we aren't able to define high integrity carbon market, voluntary carbon markets, or carbon markets in general, we need to do that before we go any further, because if we don't know what it is we're trying to do, then we're very unlikely to do it properly. We need to make sure it's aligned with domestic and national policies and national priorities. As I mentioned before, much of the voluntary carbon market has happened outside regulation and with little government oversight. Now that we're in a world where all countries need to be reducing emissions, if at different rates, but at all times, this kind of finance, especially if it grows, needs to be aligned with those national policy priorities. And we need to make sure that the claims that companies make, or companies and others make, really prioritize at source decarbonization, and that carbon credits are the icing on the cake rather than the cake itself. Thank you very much.
Mark, thank you very much for that very concise and very thorough overview of what is happening in voluntary carbon markets. People are already starting to put questions into the Q&A, so I encourage everyone in the audience, as the questions occur to you, please do so. We will be monitoring the Q&A, but not the chat. The Thunderbird and ASU more generally, Arizona State University more generally, are deeply involved in questions of how do we do this drawdown? How do we regenerate the climate, essentially? Often with something of a technological focus, but also with increasingly a focus on the nature-based solutions that Mark made reference to, which, as he said, are increasingly the focus of the discussion around carbon offset markets. And so I am very glad to be able to now introduce Kavita Prakash-Mani to talk about those. Kavita is the CEO from Mandai Nature, which is a new environmental conservation NGO recently created in Singapore by Temasek, which is one of Singapore's 2 sovereign wealth funds, and Mandai Park Holding. It has a focus on protecting threatened species from extinction, addressing a number of issues, and it works with partners to drive nature-based solutions for climate change, and working closely with local communities and local organizations to create the economic opportunities and invest in building skills and conservation capacity on the ground. Prior to this, Kavita has, like Mark, been what you could call a tri-sector athlete, leaping across the usual boundaries of sectoral divides between business and government and civil society. She was the Global Conservation Director at WWF and had previously led WWF's global practice of markets engaging companies and communities and citizens consumers. I had the pleasure of getting to know her in Singapore when she was the Executive Director of Grow Asia, which was a World Economic Forum initiative. She had previously been at Syngenta, at Sustainability in London, the World Resources Institute in Washington, and GlaxoSmithKline in India. And like Mark, Kavita is a member of the board of directors of the new Voluntary Carbon Markets Council. Kavita, over to you.
Thank you, Anne, for that introduction. And I will just go ahead and share my slides as well. So it's always nice to follow people like yourself, Anne and Mark, because it's easy to then give a very quick update and go into more detail on certain aspects of the voluntary carbon market. And I'm going to focus particularly on nature-based solutions for climate and see how we can have the triple win, as we like to call it, between climate mitigation, nature protection and conservation, as well as benefits to people. So as you've been hearing from Anne and Mark, what we are looking at with all the net zero commitments that are being made up to 2050 is a deep reduction of the current emissions that companies and countries are making through the economic activities. So we really need to be cutting down the emissions from fossil fuel use, from transportation, from food systems, etc. But there will be some level of emissions that are left that are just technically not possible to reduce, at least today, and we may get better at it. So we can use nature-based climate solutions to both, in the first half, help with the reduction. So if you have, for example, forest products or deforestation creating commodities in your supply chain, you can reduce even in your own scope 1, 2, and 3 through nature-based solutions. But even the ones that you are unable to reduce, you can offset them through removal and sequestration of carbon through nature. What does that actually look like? So actually, the current recommendation is that natural climate solutions or nature-based climate solutions provide a third of all climate solutions so far. So about 11 gigatons of emissions can be reduced through using nature. You can either protect nature, that is actually saving the standing intact forest, but also the grasslands and the wetlands. Very often we just think about it as forests, but many other ecosystems, especially what we're now calling blue carbon, is really beneficial. So whether you have mangroves or seagrasses, which capture per hectare more carbon than sometimes even tropical forests, but even grasslands. So I think one of the concerns we have right now is new carbon projects might be plowing up grasslands and planting forests, whereas we find that grasslands themselves have a very unique ecosystem and can provide tremendous carbon benefits. So one is that whole protection agenda, so the avoidance of more emissions. The second is really about managing what the lands that we have. And this is where you come down to forest products, agricultural products, and livestock products. And then, of course, we have a restoration agenda, which is really about restoring forests and restoring the wetlands that we've been talking about, and really looking at them as complex ecosystems and not just monoplantation and tree plantation across these, but looking at a combination of the trees and the shrubs and the grasses and the whole ecosystem coming together. So within that, if you were to break it down in terms of the business as usual and where we need the land sector to be reducing to get to the 1.5 degrees under Paris, of course, there's a reduction of deforestation and an improvement of the restoration of these. But again, the food system is a very, very important part of that, as it is in terms of managing the soil carbon and managing agroforestry within that. So it is really about reducing deforestation, restoring forest products, forest wetlands and peatlands, and managing our agriculture sector. But Mark was talking about this. It might sound very easy to saying we can do all of these things, but what is there are inherent risks in all nature-based solutions. So one is the additionality. How do we actually ensure that the reductions and the removals are real? And that is not that they would have happened anyway. We've had a number of examples come up where claims have been made on carbon credits and actually been traded in the market, but on deeper analysis across all of these things, you have found that these were protected areas anyway to start with, and they were not likely to be at risk of deforestation. So how can we claim the additionality of that protection? I mean, the second one is permanence. We might protect a forest, and we've seen these examples recently, but there might be a forest fire. The whole forest might burn down despite every effort that's been made, and we're seeing that across California, right down to Australia. So how do you deal with that? And there are many different ways of accounting for it in terms of having a buffer and having an additional stock that is maintained as a risk mitigation to ensure permanence. Leakage is very likely either. I mean, just as we say that, we stop deforestation due to a commodity like palm oil or soy, and we protect that forest, it is likely and has been known to happen that that production just moves to another location, and we have greater deforestation in the second place, even though we're selling credits from the first place, which is obviously not what we want to be seeing. And then there is, of course, double counting, as Mark mentioned, that two companies might be counting it, the country might be counting it, and the company might be counting it. So there are many ways of people claiming it, and we need to have a very clear registry and a very clear agreement. And this is where the Article 6, if you've been hearing that terminology, is now going to be debated to ensure that we do not double count these emission reductions. But very clearly, what we want to do is to drive that there is very great interlinkages between climate and nature and people. And so what we are seeing right now is this opportunity, of course, to mitigate climate change by investing in nature. But we also have the people agenda. We, of course, know that climate change is now driven by human activities. And also a lot of the nature loss is being driven by human activities. But we have the opportunity of bringing it back, of restoring some of these natural systems and regaining some of the climate negative impacts that we have, but also to ensure that people gain. And I think this is the third leg of the stool, where we're really saying that the people, the local people in the communities, the indigenous people, the farmers who are around these landscapes must have a benefit from these nature-based climate solutions. whether it's getting stronger land rights, getting greater access, having community conserved areas, which we know are actually more likely to conserve than even protected areas, or in fact have a livelihood gain, an income gain, a direct economic benefit from some of these solutions, so that they are seen as part of the beneficiaries of this investment, both in terms of what happens on the ground, but also what happens to their incomes. So a certain amount of coalition and collaboration is happening around a certain set of guidelines, which you will hear repeated by a number of us. So one is, first and foremost, that nature-based solutions are not a substitute for phasing out of fossil fuels and decarbonizing our economies. That has to be it, and companies must be held accountable to it. They must have science-based targets that they're adhering to in a mitigation hierarchy, which starts first with reduction and then with removal. The second, of course, is that they are nature-based, which means that we should be looking at protection, restoration, and management of the natural system, so that we do have both on land and at sea, because as we said, both green and blue carbon are both worth protecting. The third then is, of course, of saying that these should be monitored, implemented, designed, and managed with indigenous peoples and local communities, so that they champion it and they generate local benefits. And the fourth is, of course, that there is an enhancement of biodiversity, which would include all species on Earth, and that we do have a coherent benefit that is adhering to them. We cannot currently monetize every single ecosystem benefit that we have, and we know that there are many, from clean air and clean water right down to species, but we can monetize and measure carbon. So that's one way of ensuring that we are looking at these multiple benefits. And how do we look at that? I mean, we have a certain number of standards and certifications that are in place already, which do verify carbon, which are looking at additionalities of climate, community, and biodiversity standards, or an offset registry. But we can improve these, and I think there's a lot of effort now being made on ensuring that we are looking at the additionality, the permanence, etc., through these standards. And so partly the bodies that Mark and Ann mentioned in terms of the Voluntary Carbon Markets Council and the Voluntary Carbon Markets Integrity Initiative are now looking to see how are their core carbon principles that can be then applied to these standards to strengthen them further. I wanted to end with an example to kind of bring this to life a bit. And this is from Cambodia, which is one of the few countries in Southeast Asia where we operate that is allowed to sell carbon credits through a legal system. So this is a project which is the Kyosema Wildlife Sanctuary. And the project was developed by the Royal Government of Cambodia and Wildlife Conservation Society. This is one of the largest remaining primary forests in Cambodia. Very unique, with a very high number of occurrence of threatened species, rare Asian elephants, gibbons, the giant ibis. So a very, very core conservation hotspot that needs protection. And so through the carbon financing, we did have very strong measurable benefits that were accrued to this project. So we have about 25,000 hectares of deforestation being avoided, which resulted in 11.5 million tons of avoided greenhouse gas emissions, but also more on the social side, 2,500 households which were living in the area are able to protect their cultural identity and heritage. Jobs were created, education system. So, the social elements which you don't always count for conservation and very often don't count for carbon are the ones that are going to actually ensure that these projects, have a longevity because of the benefits that the communities get around it. So communal rights being recognized is very, very big, because it then empowers communities to protect those forests. And of course, having additional income generation activities like this ecotourism camp then brings a win-win and a greater, effort being put into this conversation. So let me just pause there, and very happy to pick it up in terms of questions and comments from everyone. Thank you.
Kavita, thank you so much. That is absolutely fascinating and crucial work. We're coming up on the top of the hour, but we will extend the webinar a bit past so that we can get into more of a discussion. Just to let the participants know, the audience cannot see written answers to the Q&A, so we will be addressing all the questions live. One of which was the very simple question of, what is this body called that you are now on? It's this thing that emerged from the task force on scaling voluntary carbon markets that Mark Carney and others got going. What's the name for it?
Anne, did you tell me that the questions that I've just been answering in the Q&A box can't be seen by people?
That's correct. So we have to answer them live.
It's called the Voluntary Carbon Market Council as of last Thursday, and it was previously the Task Force for Scaling the Voluntary Carbon Market. So the reason it changed name, it was just created its new governance body, and Kavita and I sit on the board of that governance body, and it's called the VCMC. Much
easier than saying the body that just emerged out of the task force. So thank you for coming up with a name. We appreciate it. So before we get to some of the questions that have been submitted in the Q&A, I can't resist asking one myself. So both of you emphasized that the purpose of these markets is a public purpose. So we can't use the governance mechanisms that are used for most markets, because usually we're just trying to make sure that they're not fraudulent, that they're efficient, that there's access to justice if somebody violates a contract, that kind of thing. But for these markets, for voluntary carbon markets and also for compliance markets, when they emerge, there's no point to having them exist unless they're actually dealing with the climate change problem. And if we start expanding this into thinking about, can we use this approach? Can we use markets to address the wider biodiversity crisis or all the other ecosystem services that Mother Nature gives us? We need to be thinking about some different principles. You both touched on these in your talk, but I'd love to hear a little bit more about them. Mark, one of the things that you mentioned was that the people who are governing these markets, which looks like it will be you, need to keep in mind this broader system. What is that broader system? I mean, everything you talked about focused mostly on the supply side. What are the projects that are out there? What's the bigger system within which this is all embedded?
Well, I think you in a way touched on that, Anne, with your inverted and upright and inverted pyramids. All of this fits in, firstly, on a lot of work we have to do, as your charts showed, to get emissions down to a level where we keep as well below 1.5 degrees as we possibly can. And as I mentioned, even this year, the size of the voluntary carbon market is probably less than 1% of global emissions, probably around 0.5%. And so, this is a small part of a much bigger picture. But climate change is not on its own. We know that, and Kavita has kind of mentioned this very eloquently in her presentation, that when we look at projects, but when we look more broadly, we need not only to stop climate change, we need to protect our natural environments. There is increasing inequality in the world and increasing levels of poverty. And for all sorts of kind of moral, humanitarian, and self-interested purposes, we need to deal with all of those issues. So climate change itself is a subset of a much broader systemic global issue, and carbon markets are one very small part of that. So when you talk about the public purpose, I think one thing we need to bear in mind about carbon markets in general is that they allow someone to continue polluting by reducing emissions elsewhere. So unless you have some kind of discount or some kind of clawback, the best you're getting is a zero-sum game in emissions terms. Now, if companies are buying credits above and beyond their moral or regulatory obligations, then you are saying you are doing something beneficial for the climate. But in purely accounting terms, it's just someone emitting and someone reducing. So the co-benefits, whether those be the community level benefits that Kavita was mentioning, or the scaling up of technology and therefore bringing prices down of certain technologies, those become very important. But going back to the climate bit, if the best we can get is a zero-sum game, we really, really need to make sure that we get that, because anything else is just allowing continued emissions, more climate change, and will be counterproductive. And just to sort of finish off, one of the reasons, and this was part of one of the questions in the box, why hasn't this market grown? And there are a number of reasons, but one that I think is absolutely fundamental is that people don't trust it, that people don't understand it, they don't trust it. And therefore, I touched on this, and it's something you and I have discussed at length. We need to have real open book transparency on this. People need to see what's happening, to be able to call out the people who are cheating, call out the people who are bending the rules, and reward those who are playing right, generating multiple benefits, sharing with local communities, et cetera, et cetera.
So building on that, so that talks about the whole system within which this is embedded and the need for extreme transparency mechanisms, which of course, market participants don't always want extreme transparency mechanisms. So it will be really interesting to see how that evolves. But Kavita, in the kind of nature markets that you're talking about, you talked about the need to make sure that local people benefit from the system, in part because they're going to be the stewards of the local ecosystems. So if it's, I think the latest figure is we expect about 70% of the voluntary carbon markets to be nature-based markets. What does meaningful participation mean? How do we engage them? What kind of voice do they have? How is the council, the new Voluntary Carbon Markets Council, thinking about that? What kind of representation for frontline communities might there be?
Thanks, Ann, for raising it. It's a really important part of the nature-based solutions, and I think it's part of the system. And I think when you talk about the system, there is a market system of demand and supply and the interaction, and then there is an ecosystem system between nature and climate, and then there is a you wrap around the humankind system around that somehow to bring it together. So it almost feels like there are interlocking systems in this, and at the core of it is the people, because I think people. Of course, we are all going to get impacted by climate change. But really, when we talk about nature and nature conservation, one of the challenges that has always been is how do we engage, equitably benefit the communities on the ground? And this is indigenous peoples and local communities. So there are many aspects to it. One is that a lot of these areas that need to be conserved are traditionally indigenous people communities or have communities living there. They may not have legal rights to it, but they have historic and traditional and cultural rights to it. They've also been custodians of these lands for many generations and have a very unique bond with nature. So our best bet is to actually empower them and give them better rights to those areas and work with them in their protection, because they are the ones who actually live there and can make or break as it is in these communities. We also need to make sure that with the broader community as well, and very often the risk to all of these conservation areas is agriculture, is expansion in crop or livestock or grazing is what we're seeing as being the reason why a lot of deforestation happens. And that happens because of poverty. I mean, poverty is the leading cause of a lot of these deforestation frontiers, whether they are tropical forests or plowing of the grasslands and wetlands. So working with these communities, especially with the smallholder farmers and the livestock people, to ensure that they have good practices, that their productivity is higher, that they are getting, in terms of whether we look at it in soil carbon or agroforestry on their farmland, that they are benefiting from all of these different techniques of climate mitigation that are then can be monetized in terms of carbon credits, that then get them the income and hence give them the incentive that they need to stop deforestation and have other sources of income are really, really important. So I think both from a what are the cultural and heritage rights? What are the opportunities and equitable sharing of benefits? What are the positive income generations that we can create are all going to actually result in much stronger conservation and hence much stronger nature-based solutions for climate.
A very comprehensive answer. So let me just raise as one example for our participants, how it is that you get that kind of engagement. Part of what you're talking about really is fundamental development issues. We also know that we need to do things in the very short term that are going to happen faster than you get that kind of allocation of property rights or fundamental development. There is a fascinating organization based out of Cambridge called True Footprint that has come up with a methodology for using phones supplied widely in a community with apps that allow them easily to communicate with each other, as well as with other organizations that are involved in whatever kind of project there is, and training of a bunch of local volunteers to go and be engaged in the community. So I'm thinking that kind of approach might be a way of making rapid progress toward the kind of deep community engagement that has to happen if we're actually going to get ecosystems preserved. Have you seen that kind of thing happen, or are we still doing very, the usual difficult development approaches?
Well, we're doing more difficult development approaches, but I think we're starting to use technology a lot more and look at how we can empower people through technology and even do measurement and evaluation through technology. So there is some progress being made, but I think we can't get away from the broader rights thing. I mean, there's stats now that are really showing that community conserved areas or lands that are under community management tend to be much stronger in terms of protection, despite all the protected areas that we might have. So, there is already inherent good models that we have, but you're right, we need to try, faster interventions rather than wait for a full social construct to change.
And Mark, getting back to your point about the need for great transparency, I wonder if there's also a role for new technologies. I know there's been discussion about, and maybe this is something the council would be interested in looking at, roles for putting everything about these transactions in voluntary carbon markets on a blockchain with some public availability. Do you see a role for that kind of technology to enable us to scale the information sharing that needs to happen if these voluntary carbon markets are going to get into the hundreds of billions of dollars?
I think a blockchain approach or decentralized registry approach is fine. I mean, but I think the prior problem is one that you've alluded to when you talked about sort of radical end-to-end transparency. I don't think the technology is the problem. I think it's the resistance of people having their possibly dirty linen washed in public that is likely to be the problem. I mean, there are plenty of accusations, some not well-founded, but many well-founded, about projects that have not been additional or have caused damage to local communities or whatever they may be. And those need to be scrutinized. And the only way we'll build trust and we'll build a market at scale of good quality, high integrity projects is if people trust them and therefore can see what's going on. So whether it is some central registry that everybody can access, which I suspect will be difficult because it'll be expensive and it's a very large bit of kit, and the organization that's likely to run it is going to want to monetize the information and the data that generates. So a blockchain approach with free public access might be the right way to go. But I think whichever technology or whichever technological approach we use, the first challenge is going to be to, given that this is a market for public purposes, we've all repeated, there should be a presumption that all information is in the public domain. And we need to get that done. We need to get that done in the VCMC, in the VCMI, probably in Article 6 under the rules of the Paris Agreement once they are agreed, hopefully in Glasgow, that people can really see what's happening. And that's not only to scrutinize, to look for bad behavior, but also to be able to highlight good projects and good activities so they get repeated and scaled. So I'm not dodging your question. I just don't have my concern is not so much about the technology, but about the principle and the putting in practice in the first place.
And if I can jump in, two further ends to that spectrum, I think where we are seeing a use of technology is in the measurement and evaluation. I think in the integrity of measuring impact, where things like satellites and drones and citizen science and even cell phones and all of these things, and we're getting IoTs and listening to trees being cut. And so there's a lot of technology that we're seeing that can be used in terms of the supply side integrity of it. But I wanted to flip to the other side as well and saying what we also need is real transparency on the demand side integrity, because there's just no way that we are now currently focusing on how do we have transparency on the companies that are buying or have a demand for these these offsets and these carbon credits, because we do want to keep them to account of saying that these need to be the last resort for climate mitigation or reducing their emissions. So what are the transparency requirements of these companies that are buying it for us to be able to see that they are following the mitigation hierarchy and science-based targets, that there is actually true investment in removal and reduction from their scope 1, 2, and 3 themselves before those offsets are made available to them. So I really would like to see the transparency across each aspect of that chain.
So this to me is fascinating, because we can touch on technologies for the measuring and evaluation side, the citizen science side, technologies like blockchain for market transparency, technology for community engagement. But both of you are saying that the issue is primarily one of politics, of power, of really making sure that the interests of both the local communities and those whose primary interest is the public purpose of the market have a way of holding sway. So we really have as much a power problem, politics problem, as we do a market efficiency problem, which I think makes a great deal of sense when you're trying to use a market for a public purpose. There's a lot of new questions that come up. Sunil, let me turn it to you for a question.
So the question I have, and I think it's following up on what both Mark and Kavita have said, that we're trying to do things at scale. In some sense, we are trying to compensate for lack of collective action in the past. And given the time we have, if I take the science seriously, one way to think about is to say, look, counterfactuals are very hard to define, but what we're trying to do is in some fundamental way bring forth behavioral change. And behavioral change in the sense that I want to know the provenance of what I consume, what I invest in, what I support. So the question is, how do you bring about this positive contagion in behavior, right? I mean, there will always be resistance from politics and power and so on and so forth. But if there's a huge amount of interest by the public, the general public, because these markets that we're trying to create are transparent, or the efforts that we're doing are transparent, or as you say, we can come up with successful examples of what's going on. How do we create that momentum? Is it through credibility, communication? You see what I'm trying to get at. We're running out of time. We have to fundamentally change behaviors in many ways, and behavior not just of the decision makers, but also of the average person.
And it's a really, really big question. It's really hard to answer, but I think, on the consumer side, what we're seeing is, I'm actually seeing a lot of mobile apps and everything being developed, and the use of technology in personal behavior change is really coming into its own. So even your energy companies are now nudging you in terms of like whether you're doing well or not doing well in terms of your energy use compared to your neighbor and things like that. So I think that level of groundswell, I think people are trying to create. But I think that the bigger question, of course, is how is the system changing, or how is individual behavior changing the system? And I think some of the comments is like, yes, we actually need a lot of regulation, and we need enforcement of regulation, because that's actually what will really drive change. And so the voluntary carbon market is currently, because the compliance market is not really there, and we're still waiting for a lot of the countries to create a compliance market, which will then enforce it to happen. So in the lack of that, we are looking at a voluntary carbon market. So how do we get to a place where this is the norm, not based on someone's commitments or someone being altruistic in some ways? So for me, the biggest thing is like, unless all of these commitments are being held to account, and that there is a real holding reporting at the end of the year, and then there is a stick, not just a carrot, that you're just not using it to sell more products. You're actually something will deter you from not meeting your commitments, which we don't have right now, because there is no accountability framework around these voluntary commitments right now. It's hard for the system to change. So I think it's all of these different elements around the system that need to come together, from the personal to the private to the regulation.
I absolutely agree with everything that Kavita just said. I would also caution that while obviously behavior change is important, often the discourse around behavior change and individual responsibility, to me, feels like our governments and our corporates and our investors putting the responsibility on us, when often it's very difficult to do. I mean, you know, I have reduced my driving as much as I possibly can, but the buses are lousy, the buses are expensive, and the buses don't go where I need them to go. So unless I'm prepared to walk for 3.5 hours instead of driving the 50 minutes, which I do occasionally, but not very often, it's very difficult. So I can be nudged, but if I received, or if we as consumers collectively received the $7 million a minute in subsidies that the fossil fuel industry got, and that was the subsidy we got for traveling better, insulating our homes, living lower carbon lifestyles, that would be, I think, much more effective than an exhortation to behavioral change. Not suggesting we don't need to do it, but I think it sometimes feels like a bit of the powers that be passing the buck to us.
That is something I very strongly agree with, that as Sunil mentioned at the beginning, there's a column in today's Washington Post that's making exactly this point, that yes, we need to change individual behavior. That's a given. We might as well do it. But it is way too late to rely on that kind of broad normative shift in a general population over time. We have very major structural issues that we need to be addressing. We are almost out of time, and boy, have the questions piled up. So let me try grouping some things together. There's a number of questions, including from some people who are trying to run investments in voluntary carbon markets, or who are in companies who are using these markets, who are trying to figure out how do they do this in a way that actually gets the job done? How do they know whether what they're investing in, whether the offsets they're buying are credible offsets? How can they do the monitoring? And a question that I would add to that is that we know that a great deal of these are quite cheap. They are so cheap, in fact, that it's very hard to imagine how you design a good project for $2 a ton. How would you answer these questions if you're advising investors or companies who are buying offsets? What should they do first to make sure that what they're doing is actually the right thing to do?
Well, I would start by taking the things that Kavita was saying about nature-based projects at the community level, but those observations are true of all projects. So you start by engaging your local community. You make sure that those stakeholders who need to be involved are involved in the decision making and co-ownership from the outset. That gives longevity and meaning to the project. Second, you're probably better off investing in the project yourself, either with by contracting someone to help you do it, rather than just buying something in the market, unless you have the expertise or the consultant who will really help you to dive deep into that. You could also perhaps say, well, I'm going to accept that the difference between the project outcome and the counterfactual is always an estimate. So maybe I'll overbuy and retire more credits than I actually need, because then, all things being equal, I'm providing a net positive benefit to the climate. So, and then you use one of the credible standards that are out there. Kavita mentioned a few that are related to nature-based solutions project. There are 4 or 5 standards which are the most widely used ones, and they're the most widely used because they are the most credible ones. They all involve independent third-party validation and verification, have random audits of projects and of the verifiers. That's not to say they're perfect, and there are many gaps in the system, and the sort of 2 initiatives that we've been referring to are trying both at the supply and the demand side to fill those gaps and aid credibility. But there's no substitute for checking the projects out yourself, not just assuming because it looks nice in the photo that it's been done properly and is really reducing emissions.
I can just add one thing to that, and Mark said it perfectly. I think what we're seeing on the ground right now is, as you said, and the price of carbon is really low. I mean, it's gone up to $5. And some projects actually can command a little more if they can show additionality and other commitments that companies may have made. So stopping deforestation, because it allows companies to tick off other nature commitments. But what we're really saying is that if you're very keen on supporting these and really genuinely want those outcomes, don't just wait for the carbon credits to be available and then buy them off the market. What we need is an investment into the project development. These projects take 2 to 3 years before carbon is actually available. And it also takes, depending on the size of the project, substantial, like, maybe $1 million a year for a sizable project to be off the ground. All of these risks are currently being taken by the project developers or are being funded by foundations or donations or development assistance, which is then just a benefit that the companies get by paying a low carbon price to buy the carbon credit at the end with no certainty and all the risks being taken by the people on the ground, whether it's price risk or regulatory risk or permanence risk or any of these. So if you genuinely want to encourage and grow the supply of nature-based solutions, we need companies to stand up and invest and support these projects right from the get-go so that we actually have a pipeline of projects when we need it. It doesn't exist right now.
So I'm going to turn now to Jay Shambaugh for a final question, if you wanted to put your question forward, Jay. And then given that we are down to our last couple of minutes, I'll ask Kavita and Mark, in responding to that, to also give whatever final comments they want to at the same time.
Great, thanks. This has been fascinating so far. Mark, I wanted to bring you back in, and Kavita, I'd love to hear your thoughts as well, towards something you discussed already, which is making sure these are kind of, in some sense, marginal products or projects, right? That these are things that weren't going to be happening anyway. And in particular, when we think around the area of clean energy projects where they're cost competitive right now, and so if they're cost competitive already, are they then just selling off offsets for something that would have been taking place because they were already cost competitive? And so I feel like skeptics of this entire market, that's where they focus, that, well, these are all things that were going to be happening anyway, without taking into account what all of you have been saying, and Ann's very nice picture of the bathtub at the beginning, that we do need marginal projects to come in that will be taking more out of the atmosphere. So how do we make sure that's what these markets are actually giving us?
So I think it's a number of quick points. One, on the renewable energy space, you're absolutely right. Most of the projects are cost competitive, except perhaps very small scale projects in least developed countries where capital costs are high. And that, for that reason, the 2 or 3 largest standards in the voluntary carbon market no longer credit renewable energy projects. They've decided that they can stand on their own. Then, you have to, the second point is how do you test this marginal additionality of projects? And the traditional way to do it is to look at the rate of return on the project, see if that would meet the investor's hurdle rate. If it's below, then it's additional. If it's above, then it's not additional. And you hope that the carbon credit will make the difference. Of course, anyone who works in the finance sector knows that companies have multiple hurdle rates for different kinds of projects and will obviously choose the one that is most beneficial for them in the project. And it's very hard, except when you've got projects that are extremely uninvestable, in which case you have to ask a question whether they should be invested in the first place, whether the carbon price is going to make the difference. I have, and others have suggested over the years, that perhaps one way to do this is to say, let's not get too hung up about the additionality, but let's try and, in terms of the investment return test, but instead let's identify those project types or those technologies which we clearly know that we need to have, whether that be regenerative agriculture or protecting a wetland or reforesting a mangrove, that we must have, that we can say with reasonable certainty are not going to happen without some carbon finance, because there isn't public money, there isn't, and say that for a limited period, 5 or 10 years, we'll allow those kind of projects and we'll continually review them. And as some of them become like wind turbines and commercially viable, then we just eliminate. The projects that already exist can continue. And we find some other way of dealing with that. And we recognize that there will be some, false positives and false negatives. And so we apply a discounting system so that we're making sure that the climate is whole. And we just need to think of radically different approaches. The idea that we will have certainty is a myth in the first place. As you say, when we're dealing with counterfactuals, we can never know for sure. So let's think of other ways of doing it that get what we need and don't get us too hung up on the other stuff.
And Kavita, any response and any final words?
Yeah, I was just going to say that, and one would hope that we had enough investment going into nature protection that we didn't need to always put carbon finance into it. I think this is just trying to get multiple outcomes by the little pool of money that we have going into conservation and climate at this point of time. It is dramatically underfunded in terms of the outcomes and that we want. So we are looking at all forms of financing, and usually it ends up being a blended finance model where you have commercial finance, you have demand for carbon, you have foundations, you have ODA, all of this. And so people are like mishmashing everything in and trying to make these projects actually viable in its own things. I think the true price of carbon definitely needs to be there. And I think the last thing I would say is, when we're looking at nature-based solutions, then it's a public good times 3, because you're looking at the public good in terms of the carbon, you're looking at public good in terms of the nature conservation, and you're looking at public good in terms of the people development agenda, which is all linked back into the SDGs. So if you're looking for a bang for a buck, that's not economic return, but getting us all the things that we're all truly waiting for in terms of the SDGs, then there is a real need. But we are not monetizing it, and we're not actually putting numbers. We can't actually put numbers behind all of these things. They don't come up in the same value as, say, a renewable energy investment, which we need both. But they also have the beneficial, the additional benefits that we're looking for.
Great. Kavita, Mark, thank you both so much for participating. I know you both have to get back to your very important work. Jay and Sunil, thanks again for co-sponsoring this. And to the audience, thanks for sticking with us through what I hope you have found as fascinating as I have. Thanks all very much.